There's a sense in the market that a new era has been ushered in for IPOs. One of the most successful IPOs in recent memory was launched in early June by CAVA Group, a fast casual restaurant chain focused on Mediterranean food. For the last decade or so, any investor who was looking at the Chipotle chart and valuation probably thought to themselves, can it actually go any higher? And guess what? It actually did. Now they're looking at CAVA, wondering if they can do the same thing. Chipotle stock is a 47 bagger since going public in 2006. Let me repeat that, a 47 bagger. Naturally, everybody wants to find the next one of those.
I want that.
And the stock is off to a strong start. But will it mark a TSN turning point for the IPO market, or will it be an anomaly ahead of a bearish downturn? Is CAVA a stock that you want to own? Well, let's dive in. On June 15th, CAVA Group became the latest firm to IPO on the NYSE. To much fanfare. NYSE President Lynn Martin herself commented on the event, stating that CAVA's listing symbolized a positive sign for the IPO market. This is particularly noteworthy given the last 18 months, which has seen the slowest IPO market since the financial crisis back in 2008.
Can we actually say there's a thawing now of the frozen IPO pipeline, or is this a one-off?
Thanks for having me on, Morgan. And I think today really shows the green shoots that are existing in the IPO markets. Obviously,
the initial public offering valued the restaurant chain at $2.5 billion, while raising nearly $300 million under the financing. Initially anticipated to come in at a range of $17 to $19 per share, the IPO was ultimately priced at $22 a share, beating expectations while causing the equity to rally as high as $47 on its opening day. Shortly after, the equity tanked, sinking as low as $36, but the name has since posted a sharp rebound. So let's start off with, who is CAVA Group? Founded in 2006 by Ted Zinoristo, Ike Grigoropoulos, and Dimitri Machovidis, the company started off by offering shared plates and an inviting guest experience that quickly gained popularity. As early as 2008, they began selling their signature dips and spreads in local grocery stores. 3 years later, they opened their first retail store location, adopting a build-your-own-meal approach akin to Chipotle. This fast casual model emphasized healthy, flavorful ingredients such as harissa and tahini. CAVA Group says that their rapid growth comes from the idea that more people are health conscious, citing 70% of people want to be healthier, and approximately half of all people place healthy eating as a top priority, according to an independent third-party survey. Their success didn't come without a little bit of acquired growth. The strategic acquisition of Zoe's Kitchen, a competing Mediterranean chain, for $300 million back in 2018 marked a key milestone in its story. This played a significant role in CAVA's expansion. Transforming locations into CAVA restaurants was a cheap and cost-effective way to bolster its presence. Fast forward to today, and CAVA operates 263 locations, offering a range of dishes such as avocado bowls, chicken pitas, and falafels. The story is rather vanilla compared to some of its peers. The biggest controversy that has embroiled the chain to date appears to stem from a tweet it put out in 2021 on its diversity, which caused a bunch of white guys to get up in arms. A real shocker. So there hasn't been any Papa John's type controversies, and it's not exactly like they have a history of foodborne illness outbreaks like one of their peers. I'm looking at you, Chipotle! Well, a large part of CAVA's growth can be attributed to the purchase of Zoe's several years ago, which we mentioned earlier. The reason for this is twofold. Firstly, it made CAVA the only national player in the rapidly growing Mediterranean fast casual dining category. This strong grasp on market share enabled revenue to grow at a compounded annual growth rate of 52% over more than half a decade, with revenues hitting over $500 million in 2022. Secondly, the acquisition enabled cost-efficient expansion of the CAVA brand by simply rebranding restaurant locations. To date, 55% of these locations have since been rebranded, doing so at a much lower cost than if they had just opened a new store from scratch. Furthermore, CAVA's high annual unit volume enables it to leverage fixed costs and unlock strong restaurant-level profitability effectively. The company on average makes $2.3 million a year from its stores, which equates to a cash-on-cash return of 35% or a payback period of 3 years. However, akin to many other companies that have gone public recently, the company still struggles to make money. CAVA posted losses of $37 million in 2021 and $59 million in 2022. Well, the company may not have direct competition specifically within the Mediterranean segment of fast casual dining. That's not to say that there aren't any direct competitors. There's a myriad of companies that are in competition with CAVA that are public, that are the same size or bigger. Let's take a look at those and let's get into some of the multiples and break that down. Now, before I get into the multiples, just for anybody who's kind of new to the financial markets and you're not sure what you're looking at when we're talking about multiples, think of it like this. You're just going and buying a loaf of bread at the local grocery store. The cheaper the price, the better. So I know we hear these ratios and we think that they're complicated. It's actually quite simple. The companies with the lower ratios are said to be cheaper. The companies with the higher ratios are said to be more expensive. In general, the market's somewhat efficient, so there's usually reasoning behind that, such as cash flow generating ability, future prospects, market sentiment. There's a company could have a whole bunch of predatory loans on their balance sheet. There's a whole bunch of reasons why you can't really use these multiples out of a vacuum. But in the interest of not making this video 35 minutes long, this is just sort of a back of the trading card way of just kind of keeping track of how these companies are trading and what those valuations look like in comparison to each other. First up, we have Sweetgreen, which brands itself as a fast casual restaurant chain that serves only fresh, healthy food such as salads and rice bowls, and has over 180 restaurants in the US. They IPO'd in 2021, experiencing much of the same initial excitement as CAVA. In the time since, it's down almost 80%. The company couldn't live up to the hype and has continued to produce subpar results. Its market cap is now down to $1.5 billion. Sweetgreen trades at a 3x price to sales multiple and currently doesn't generate any EBITDA, so we can't use an enterprise value to EBITDA metric. Quickly, if you're asking me what's EV and what's EBITDA, EV is just market cap, so the valuation of the company, but we're going to add back on the debt, less any cash. So it's just another valuation metric that takes debt into account. And if you're wondering what EBITDA is, think of EBITDA, it's earnings before interest, tax, depreciation, and amortization. All it simply means is what's the company's earnings after we take out some of those challenging, sort of wonky accounting figures that make it a little bit more inconsistent to look at. It's not a perfect metric if you're going to bet your life savings on a company, but it's just an okay comparable for established, regular cash flowing companies. Up next, we have Shake Shack, another company whose name has been thrown around as being comparable to CAVA. This is your traditional American fast food company serving burgers, crispy chicken, and milkshakes. They have approximately 400 locations and were listed on the NYSE back in 2015. Today, they boast a market cap of $3.3 billion. And they trade at a price to sales ratio of 3.2 with an EV to EBITDA ratio of 59, which is very, very high, which means that the market is pricing in a significant growth for the company. Now, in general, when I think of EV to EBITDA, I think of a regular boring business as being expected to be sold for around 10 times EBITDA. So with Shake Shack trading at 59 times EBITDA, it tells us that the market is expecting significantly higher EBITDA in coming years, and they are pricing that in by buying the stock all the way up to 59 times EBITDA. And of course, lastly, we have Chipotle Mexican Grill, a similar fast casual healthy alternative to fast food, which sells a wide variety of Mexican dishes. They currently have over 3,200 restaurants located around the world. The company has been one of the most successful investments since its IPO back in 2006. Chipotle first went public at a $175 million valuation. Fast forward to today, and the company is now worth nearly $60 billion. But the steep valuation of CAVA has raised eyebrows. With a $4.5 billion market cap, CAVA is valued at an astounding $17 million per restaurant, which is close to being on par with the $18.3 million figure boasted by Chipotle. CAVA's successful public listing and subsequent trading could mean positive things for interest in IPOs. And the IPO is not the only reason why we're seeing people scream about there being a new bull market. The Federal Reserve's decision to halt its streak of interest rate hikes is an auspicious sign indicative of some headway in the battle against inflation. Moreover, the market has seen bullish trends with the S&P 500 up by more than 20% since its low in October. Employment figures and consumer spending are robust, and there is increasing optimism surrounding technology stocks, especially Nvidia, which has gained almost 200% this year, primarily due to the AI boom. So let's wrap it up. CAVA's IPO is a positive sign for a market that has been filled with plenty of doom, despite the rally in the S&P 500. Whether it represents a bellwether or a simple anomaly is yet to be seen. However, in the current market, we'll take any sign of positivity. From an operational standpoint, the company has posted impressive top-line growth, and its expansion strategy is clear and quite simple. They wish to hit a target of 1,000 locations by 2032. If the market values a restaurant chain at a multiple based on a simple location count, it's easy to see where this is going. But who knows what value will ultimately be ascribed to each location. The company also has the issue that most major growth companies have of late, which is continuous net losses. Whether it can achieve profitability remains to be seen. Now, all that being said, the clear consumer choice in any market is certainly worth something. And as always, the question that we have to ask is how much? All right, guys, what do you think? Do you think that CAVA is a stock worth owning? Do you think that this recent sort of great IPO news is just an anomaly in what is going to prove to be a further bear market? What do you guys think? Also, if you enjoyed this video, do me a favor, smash that like button. If you haven't already, subscribe. And guys, let me know what you think in the comment section. All right. Thanks, everybody.